It sounds like a cliche, but the one word keeping chief executives up at night is disruption. If you're the CEO of a big company, all it takes to get you paranoid is to hear that Amazon is about to invest in your sector. For example, when Amazon acquired online pharmacy PillPack for less than $1 billion last year, leading brick-and-mortar rivals Walgreens and CVS instantly lost $11 billion in market value. So it's no surprise that CVS spent $69 billion to buy health insurer Aetna. Why did they do that? It was a clear response to Amazon's plans to enter the business of selling prescription drugs online. The fear that Amazon or other tech giants such as Google, Facebook, Apple, or even Uber can muscle their way into any sector is forcing legacy companies to take risky bets on big acquisitions. That's the only way they can stay relevant and fight the disruptors. For example, IBM made its biggest acquisition in its 107-year history by buying an open-source software company called Red Hat for $34 billion. The logic of this deal is very simple. The lucrative cloud computing business is dominated by Amazon Web Services and Google. If IBM wanted to catch up in this business, it needed to make a big acquisition. The other big disruptor has been Netflix. The TV streaming company has forced a number of telecom and media companies to forge new alliances to stay relevant in their businesses. Boring telecom company AT&T agreed to pay $108 billion to buy Time Warner. That's the owner of HBO and CNN. Last year, Disney and Comcast entered into a bidding war to buy most of Rupert Murdoch's 21st Century Fox. At the end, Disney prevailed, but still, Comcast ended up buying European broadcaster Sky. We should expect more of these kinds of deals. Cash is cheap due to historically low interest rates, and many companies have a ton of extra cash on their balance sheet thanks to Donald Trump's corporate tax cuts.
This tax bill is incredible.
The conditions to make big deals are as good as ever.